So the floor is yours, Stefania. You have 50 minutes. I may interrupt you during this period for clarification questions from the floor, and then there are 10 minutes of open discussion.
Okay. Well, thanks, Jill, and thanks everybody who's tuned in. So today I'm going to talk about more of an agenda than a paper that I've been pursuing with one of my graduate students, the Banque where we're trying to use basically the tools of machine learning to gain a better understanding of consumer default risk. And, you know, I don't need to explain this to this audience, but in the United States, but also in Europe and pretty much around the world, there has been a tremendous growth in consumer credit. And here I'm thinking about all types of credit, mortgages, credit cards, personal loans, and so on. So this is just data from the Federal Reserve that plots total consumer credit in real 2018 dollars starting in 1985. And so though default rates on consumer credit are not that high, in fact, you know, if there are variations in default rates in consumer credit, they have a pretty large macro impact at this point. And on the right-hand side, you just can see, again, from Federal Reserve data, just the aggregate delinquency rate, meaning 90 days past due rate on all consumer loans starting also in the mid-80s. And you can see that it mostly hovers around 3.5% to 4%. It's cyclical. There was a spike during the Great Recession. And so what we're interested in is sort of understanding better, you know, consumer default risk. And our premise is really that in the US and increasingly also in other countries, the allocation of consumer credit is based on credit scores. So credit scores are basically rankings of individuals based on their expected default risk that are generated from proprietary models that credit bureaus have. And, you know, based on credit scores, what happens is that individuals are, what credit scores determine is basically the amount of credit that individual borrowers may get, and also the interest rates that they pay on that credit. So there is a system by which your expected default risk determines how much credit you have, how expensive your credit is, but then those variables also determine your probability of defaulting. And so since you know, these models of default risk that underlie the construction of credit scores are proprietary, and by law, we don't really know very much about them, though I'll get into that a little bit later. So our premise, what we want to ask is whether we can develop a better understanding of consumer default, so try to find what the factors that are associated with default more strongly are, and maybe even think about different types of default that are interesting from a policy perspective or from a lender perspective, such as strategic versus distressed default, but also, you know, have a lot of transparency and use a technology that, you know, is particularly suited to looking at these problems with the kind of data that we have and lenders have, and that possibly, you know, does better than credit scores, because credit scores do not have a great track record of, you know, actually ranking consumers in the optimal way. And so what we're doing, you know, in this whole agenda, we're using credit report data, so which is the same kind of data that credit scoring companies have access to. And we're using exactly the data that you can use in a credit scoring model. So the Fair Credit Reporting Act is a piece of legislation in the United States that was first introduced in the early 70s that determines what information enters your credit report, and also what information in that credit report can be used for credit scoring. And I'll talk about that a little bit later. And then what we want to do is, in developing this model, essentially this model could be an alternative to a credit scoring model, but it also allows us to assess the performance of, you know, widely used credit scores. And the goal, as I said, you know, is essentially to increase transparency and accountability of lenders and credit scoring companies that use these models to allocate credit. But not only that, you know, employers use credit scores to assess job applicants. Landlords use credit scores to decide whether to rent to people. Insurance firms use credit scores to risk price, customers. So they're very widely used, and we think that improving, our predictions of individual default risk could ultimately also improve the allocation of credit, since that is based on these predictions, and possibly also lower default rates individually and in the aggregate. And of course, it can have some benefits for policy design, particularly policy with respect to bankruptcy and foreclosures, but also from a macro perspective. Okay, so now, what is the literature? So in terms of what we are trying to do, there isn't much, but our work is related to the large literature on unsecured default. So there has been quite a bit of work that's been quantitative in nature, where unsecured default has essentially been equated to bankruptcy. What I show in my paper with Jaromir Nozal is that, in fact, bankruptcy, is a very, very small part of overall consumer default. Most people who default are not able to file for bankruptcy. Some of them because they cannot afford it. This is our main point. Others because they're not eligible for whatever reason. And so this literature, though it's great from a theoretical perspective, it doesn't really model default the way we see it in the data. So it doesn't provide a huge guidance, in terms of thinking about the defaults that we observe. There's also a large literature on mortgage default, particularly, after the housing crisis of 2007-09. Here, I'm just citing selected papers that try to get at, the determinants of default, whether it was negative equity or an income shock and so on. And so we sort of related to that. And on credit scores per se, I would say, that as economists, we haven't thought really hard about them so far. Obviously, there was a big discussion of credit scores when we were thinking about subprime borrowers during, the 2000 housing boom and then the crisis. But other than that, there isn't much work sort of trying to think about what credit scores are supposed to do. In theoretical, from a theoretical perspective, there's a paper by Chatterjee, Corbett, Dempsey, and Rios Roll, where they develop, a private information model in which credit scores have a role. And then from an empirical perspective, partly because, credit score are proprietary models and not everybody has access to the underlying data, there hasn't been, a lot of work. And the empirical papers that are out there often are in the operations research or more industry, related type of work.
So, Stefania, can I ask you a question?
Yeah, sure.
So, because you say there that you're going to use the same models that the credit score companies use. So
no.
No. The same info. Exactly.
Yeah.
Because there are restrictions on some kind of features that you cannot use, right? That it will be illegal.
Yes, yeah. So I'll get into that actually in a couple of slides.
But why not to use? I mean, it's true. I wonder, maybe it's not legal to do it, and maybe they say that they don't do it, but on the equilibrium path, maybe they use other information.
Well, so though credit scores are super important, for pretty much any loan, in principle, lenders should not just use the credit score. Like if you're applying for a mortgage, they'll check your credit score. That's going to put you in a risk category, and then they'll, most mortgage lenders will want to see a history of income and so on. So, most lenders will not exclusively use the credit score, but it's true that, for example, for credit cards, particularly the ones that you just apply online, they ask you for your income, but it's not verified. And so literally your credit report and your credit score are the most important factors. Credit scores are very, very important. They're not the exclusive variable that is used, but they are, even if when lenders use other factors, most often the credit score is the most important factor for determining, say, the interest rate. Or how much you're going to borrow. So it is an important variable. But let me try to, get to that as I explain, what the problem is. So first of all, what kind of default are we talking about here? So we, in our work, because we have this goal of sort of comparing with the credit score and being applied in this sense, we use the industry definition of default. So the outcome that the credit scoring models look at is being 90 days or more past due on any debt in the subsequent 2 years. Okay, so that's what they're trying to predict, and so rank borrowers against each other with respect to this particular default outcome. So from now onward, when I say default, I will mean this. I will not mean any other type of default. So any debt being 90 days or more past due in the next 2 years. And so you can think about the problem in the following way. So you have a variable D for a borrower I at a given time T, which can be 1 if the borrower is 90 or more days past due, or it can be 0 if the borrower is up to 60 days past due. And then what you're looking at is the state D in the next 2 years, essentially. So you are going to be not in default if in the next today and in the next 8 quarters, your DI is going to be equal to 0, or otherwise you're in default. So you're in default whenever in the next 8 quarters, you have at least 1 quarter in which you're 90 days past due on any debt. So this is the outcome that is targeted by credit scoring models. And what credit scoring models do, they produce an ordinal ranking across consumers with respect to the probability of being in the state YTI. Okay, so this is, we are going to follow that, basically, and define default exactly in the same way. To give you a sense of, what this variable looks like, because essentially when you're trying to predict default, you're trying to predict the transition. This is just in our data, and I'll get to the data in a second, what the transition looks like. So this is no default to default over the next 8 quarters. So the fraction that are in no default and remaining no default is about 80%. The fraction who are in default and remaining default is about 93%. And then there's about 22% of people who switch from being from no default to default. And so what you can see from this is that this default state is quite persistent. And so that, in and of itself, could make the prediction problem relatively easy. But on the other hand, there is a large fraction of people who switch from no default to default at any given point in time. So how do we think about then this problem? So you can think about a transition function, which is, plots out or traces out, the probability that you'll be in a given state, 0, 1, little y, with your default outcome based on information up to the previous period. So f would be the information that you have. And then we can think about modeling this transition function with a function h, which is parameterized by some parameter theta. And so xi minus 1 would be the variables or features that we observe on an individual borrower up to when we are making that prediction. And so this is essentially captures the prediction problem that is embedded in a credit scoring model, and it's the same prediction problem that we'll analyze.
Can I ask a quick question?
Yes,
question,
sure.
Stefania. So is there some indication on the intensity of default? So you would think that if you're, late on a couple of bills would be different in terms of your credit score relative if you are late on a whole bunch of things.
So basically this is answered in your definition of default. So basically the industry considers being late up to 2 months late not a big deal, and if you're 3 or more months late, they classify you as being in default. And this is because, and we've looked at this in the data, people who just miss 1 or 2 months of payments, so that those kind of delinquencies are very transient, and when you get to 3 months or more, those delinquencies tend to be more persistent, and so they're seen as a stronger signal of financial distress. So that's sort of embedded in that. you know,
but beyond that, in terms of like the extent, so if I'm late on a $200 versus $1 million,
are proprietary, and I'm actually, you know, though I've studied the response of credit scores to different types of delinquency, it's you know, it's sort of hard for me to, you know, write a paper exactly on that. But what I can tell you, having looked at the response of credit scores, is that a minor delinquency does make your credit score fall by a lot, even if you start with a high credit score and then it stays persistently low. So it, you know, so delinquencies, even if you miss 2 payments, they have a negative effect on the credit score. But default is seen as 3 months or more because those types of delinquencies tend to be quite persistent, and so they're interpreted by the industry as being more of a signal of financial distress. So we have access to credit report data from Experian. We have a nationally representative sample of about 1 million people from 2004 to 2015. And so if you know what's in the credit report, it's all consumer debt except for payday loans, and, you know, balances, credit limits, delinquencies of various types of severities, public record items such as bankruptcies and so on. We have access to a credit score for all consumers, a conventional credit score. And then, you know, the date of birth and the zip code are used as individual identifiers. They cannot be used in credit scoring models. And we also have access to some income estimates. So what Jill was asking, so before, all information that's considered a protected, to be in a protected category, race, gender, religion, marital status, and so on, is not collected in the credit report. So we don't see it in the data, and in principle is not supposed to be used by lenders, you know, when they make credit decisions. Age is not something that lenders, that credit scoring companies can use in the credit scoring model because that's a protected category. But age is something that you know in a credit report just because date of birth is an identifier. Similarly, zip code cannot be used in credit scoring models because it's highly correlated with race, but it's something that is in the credit report because it's an identifier. So this is just to give you a snapshot of the data. Now, what I want to spend a few minutes on is why did we, you know, decide to look at machine learning and deep learning specifically. So this is based on my own experience modeling bankruptcy, mortgage default, and you know, unsecured default in a variety of different papers, where the degree of heterogeneity and the degree of high order nonlinear interaction between potential explanatory variable is such that, you know, standard econometrics tends to do very, very poorly. Also, you know, we do not have in our in this kind of data, say, good information on income by which we can have income shocks and so on. So it's just a really hard problem to tackle with standard econometrics. On the other hand, machine learning, which is a tool developed for prediction, is really good at sort of capturing these associations and regularities in high volume, high dimensional data. So from a, you know, example perspective, it seems like a better statistical tool. And mostly we are using deep neural networks, which I will give you an overview in a few slides, that are particularly suited to capturing this multidimensional nonlinear interactions. And another advantage that in general this methodology has is that we do not need to make any assumptions on normality, linearity, variable independence, and so on, which, you know, is appealing if it's hard, you know, in the data to, you know, really characterize, you know, default of different types because there's so much heterogeneity, as I found in previous work. So this is a really popular methodology, so it's being used all over the place. So these are just some current popular applications of exactly these types of network. So
I can just make, you know.
Yeah.
I mean, this is a branch of econometrics where you don't care about the estimated coefficient. You only care about fitting, right?
Yes, but actually, and that's a
what it is,
limitation
right?
from an economic perspective, that you then do not have the analog of these estimated coefficients that allow you to interpret what you find. But we look at a class of so-called interpretable machine learning methods by which you can recover something like those estimated coefficients, which allow you to then understand, for different types of agents, which, factors, which explanatory variables matter most for their default outcomes. So I'm going to get back to that. So you pointed out what the main limitation from an economics perspective is of these approaches. They do really well for prediction and fitting, but then it's hard to interpret what you get. But now there have been some real advances in that area. So we are going to use that precisely. So hopefully that's going to come back later. Okay, so there's not that many applications in household finance. So this is a paper that came out a couple of years ago on mortgage default, where they do, their purpose is different, but they use a similar methodology. I'm going to talk about a related paper a little bit later that also looks at machine learning and credit scoring, actually, Paul's paper. Okay, so I'm going to quickly walk you through an example of what a neural network looks like, and then I'm going to jump to the results. So, and I'm going to try to be fast and efficient here. But the way you can think about it is as following. So you have an input layer, and that is just your data. And then there's an intermediate layer or hidden layer that has some neural network nodes, and then you have an output layer. You may have many of these intermediate layers, and in fact, a deep neural network needs to have at least 3 intermediate layers. So what you basically do is, as you estimate the model, you estimate a set of parameters where the W parameters are the weight of the connections between different units in different layers. And the B parameters are called biases, but they're basically constants, or the constant in your regression coefficient that are associated to a particular unit in a particular layer. So that's you have an estimation problem, essentially. It's not that different from a standard regression problem. So if you look at the example that I showed you with these 2 layers, so these would be the 2 sets of W's and B's, and this is the size because this is the number of connection that we have from the input layer to the intermediate layer, and then from the intermediate layer to the output layer. And forward propagation is how the model works. So you would, in the first layer, you get the data X, you apply the weighting and the bias, and then that gives you an output Z. On the output Z, you then apply a nonlinear activation function that gives you the output for that layer. And then, you get to the second layer, you plug in the output for the previous layer, you apply your weighting, you apply your bias, you get an intermediate output, and then you apply the activation function again, and that gets your final output. For the 2-layer model, that is actually our the final number that we get, which is going to be a number between 0 and 1, which can be interpreted as a probability, in our case, the probability of being in this default state. And then you can use a threshold to then determine that if that H is greater than the threshold, then it's a 1 versus a 0. So this is how the model would work. And backward propagation is just simply estimation, is where you choose the parameters of the model to minimize some loss function on a set of training data. And so the loss function has, this is the loss function that we use because we have a 0-1 outcome, but there are different types of loss functions that you can use. So this is, a simple neural network, what you do. It is a regression problem. So, but the parameters are different from what you would get in a standard regression. So what's also important is that you estimate the model on some training data, but then you evaluate the model on a completely different set of data, which is referred to as testing data. But before you evaluate the model on the testing data, there's a number of steps. First, you have to choose the model class. So here we were dealing with neural networks. In the paper, we also consider some tree-based models. Then for each model class, you have to think about the specification of the model. So these are the hyperparameters. So in the previous example, it would be the number of layers, the number of units per layer, what kind of activation function you want to use. And so what you can do is basically optimize those hyperparameters by looking at the performance of the model on so-called validation data, which is separate from the training data. So this is just a data set that you use on the side to see which model structure is best. And then another issue that comes up with this model is overfitting. So you can do really, really well on the training data set because you're fitting that data set, but then when you go out to sample, you do really poorly. So to avoid that problem, there is a dropout rate. So you randomly drop some observations. So this is a 50% dropout rate, is pretty standard in the literature. And then you have the testing data, which is the data on which you actually want to run the prediction, which is fully out of sample. So what our process was for developing the final model that we use, which is a deep neural network gradient boosting hybrid, was to evaluate a broad class of models and look at their performance, their relative performance on testing data. And then we settled on this model, which was the best performing overall. And what we also do in the paper that I don't have time to do is that we evaluate how much better a model that is a deep learning model does relative to, say, logistic regression, which is a basic technique that we think is behind most standard credit scoring models. I don't have time to go over that here, but I'm just going to show you, some results from our model, and then talk about the applications and the interpretations of using this approach. Before I get to that, I need to sort of illustrate another thing that we do, which is exactly how we run the model. How do we use the data? So essentially, if we have a quarter for which we want to predict default rates, say 2008 Q1, so we train the model on data from 2 years prior to 2006 Q1. So for predicting default rates in 2008 Q1, we use data from 2006 Q1. So we have this 2-year window between the training data and the testing data. And this is just based on this definition of default, which looks at whether you are ever 90-day more past due in the next 2 years. So that's why we did it with this 2-year window. We also tried some different windows. It was quite similar. But it's important that we only use one quarter of training data. We could use more. What that buys us is that for anybody that has a non-empty credit record in just one quarter, we can give them a prediction, which means that we can score them. This is important because actual credit scores leave many people unscored. There's about 11% of consumers, based on a Consumer Financial Protection Bureau study, that do not have a score. And so if you don't have a credit score, it's hard for you to have access to credit. So with this approach, we can score a lot of people. So for the 2006 Q1, we would split that in an 80-20 split, where 80% of the data from 06 Q1 is used for training, so fitting, and 20% of it is used for validation, so optimizing the model with respect to its hyperparameters. Okay, but then the model evaluation is completely out of sample for 2008 Q1, and we do it for every possible quarter in our data. Okay, and the other thing that I need to tell you about, which I'm not going to spend a lot of time on, is what explanatory variables we put in the model. What are the X's? Now, with this approach, at some level, this is not super important, because the way the estimation works is that if there is a variable that is uninformative, it will just get very, very low weighting in the estimated model. So we don't need to worry very much in advance about having too many variables. We probably need to worry about having too few. So that's going to be a concern. So we have a very inclusive list of variables, which is reported in the paper. I think the total number of X's is 96. Okay, but there are no lags. They're all contemporaneous. So if we're predicting for 2008 Q1, it would be the values of these 96 features in 2006 Q1 that train the model, and then the same features are used in 2008 Q1 to deliver the prediction. Okay, so let me just give you some properties and then get to the interpretation. So what you see here are the predicted and actual default rates in the population for every quarter. So the model is retrained and used for every quarter. So the quarters that you see here are the validation quarters, so when the prediction out of sample actually occurs. So the top lines that you see here are for everybody in the population. And so the yellow line is the predicted default rate on average in the population for the model. The gray line is what we observe in the data. And what that tells you essentially that the model tracks the aggregate quite well. And what you see at the bottom, it's the same two lines, but for restricting attention to the population of those who are current in the quarter, meaning they are not already in that default state. So it's harder to predict, transitions into default for these people because the transition is lower frequency for them. But even in looking at this current population, you can see that the aggregate prediction of the model and the aggregate default rate for these people in the data match quite closely. In the paper, we have a whole section when we think about macroprudential policy and how these kinds of models can be used to thinking about macroprudential risk. I'm not going to talk about it much here, but safe is to say that if you're the Fed or if you are a regulator that's tracking the consumer credit market and you want to think about default risk on that market, obviously aggregating those prediction or averaging them out with these kinds of model gives you a sense of how aggregate default risk is varying in the population. The credit scores, because they're just cardinal measures, and they are designed to always have the same distribution in every quarter, irrespective of what the actual average default rate is, cannot be used for this purpose. So there's the advantages of having an ordinal measure, from an aggregate perspective, can already be seen here. The next graph that I'm going to show you is just the true positive rates and the false positive rates in the population. So this line is the true positive rates for the population of all borrowers, and you can see that it's about 70 to 75%, which means that for people who actually end up defaulting, we catch 7 to 75% of them with our model. Instead, the false positive rate for all consumers is this orange line here. So these are consumers who don't end up defaulting, but we according to our model, they default. So that's the false positive rate. So that's about 12%. And then these other two lines here are the true and the false positive rate for the population of current consumers who are not already in default. And you can see that the true positive rate is much lower because it's harder to catch defaults for these consumers, but the false positive rate is kind of the same. Now, so this is just like an overview of what the model result looked like. So in the paper, we go through a performance evaluation that is pretty extensive. So here I'm just going to keep things very quick, and I'm just going to focus on what is the most widely used performance metric for these kinds of models in the literature, which is this receiving operating characteristic curve, which basically traces out how the true positive rate, which is plotted up here, varies as you change the classification threshold. So where you are going to decide that probability higher than that threshold means that it's 1 versus 0. And so if you were if you had a perfect prediction, the area under this curve here would be would be 1. And so the closer you can get to 1, the better is the prediction. So basically our model does pretty well. It usually gets an area under the curve around 92 to 94%, depending on the quarter. This particular quarter is 2013 Q4. So this is the AUC score, across all the quarters that we consider. And what's interesting here is that the performance is systematically pretty good. There isn't even much of a drop in performance at the height of the financial crisis, which is here. And in the paper, we look at about 8 or 9 performance metrics. Here, I'm just reporting accuracy because it's very intuitive. Accuracy is just the % correctly classified. And that's about 86 to 87%, based on our model. Now, this is Jill's question, the interpretation. So I started out saying we want to better understand consumer default. Well, what have we understood, so far? I've just shown you that there is a model that does pretty well at predicting this default outcome that is targeted by credit score. So what do we in fact understand from this model in terms of the questions that as economists we're usually interested in, so, such as which variables are most closely associated with default when defined in this way. And so this is where this interpretability property plays a role. So interpretability is the ability to figure out, which of your explanatory variables, which of the x's are most closely associated to the outcome that you're trying to predict. So you're trying to get some marginal value of the contribution of each x to the default prediction. And so the concept that we're going to use for this is so-called the SHAP criterion. It's actually based on a game theory concept, where it's in game theory, it's just a rule for assigning payouts to players depending on their contribution in the game towards the total payout. And the way we can think about it for this problem is, suppose you have a feature J, say total debt balances, and an instance I. An instance I would be a particular consumer. And so you have n possible features, n possible instances. So basically the way you can interpret the Shapley value is that that feature value xyj contributed phi ij towards the prediction for that instance compared to some baseline. And usually the baseline is the mean prediction. So if you look at an instance I here, there's going to be a particular prediction of default for them, say probability 89% of default. And so what the Shapley values do, so this would be the baseline prediction, so the mean prediction in the data set in which this instance lived. It gives you the marginal contribution of each feature to that prediction for that particular instance, for that particular consumer, as a difference to the baseline. And that can be positive or negative for any instance. And if you just want to know a particular feature, say total mortgage balances, how important is it? So usually what is done is you just take the average across instances of the absolute values of these fees. And so that tells you, so if a feature total debt balances is very important for all instances, even if for some instances it contributes positively and for some instances it contributes negatively, it's going to have a high, Shapley value. But there could be a very broad distribution of Shapley value across instances. So for a single consumer, having more or less, say, mortgage balances may contribute positively or negatively to their own prediction of default, depending on everything else that they've got going on, in their debt portfolio. So this is, yeah, Jill.
Intuitively, you estimate a nonlinear model, and then you recover some marginal contributions. It looks like you might have estimated a probit in the first place, and how different are those fees from the probit coefficients?
Yeah, so we haven't tested that, so I don't know the answer to the question. I do know that if you look at the performance of a probit in this case, it would be worse from just the standpoint of ability to predict and fitting the data. So then the trade-off is, are you okay with a quote worse model that is more easy to interpret, or do you want a better performing model, and then you have to do some work to get the interpretation? And I guess we're sort of going in the other direction, so we are looking for this better performing model. And at some level we also think that we can learn some things from it that we wouldn't be able to learn from a regular probit. So just to give you a sense of what these SHAP values look like, and the fact that they can be quite different across different types of agents, exactly because there are all these, very individual nonlinear interaction between the variables. So this is a plot of the distribution of Shapley values across instances. And let me just focus on total debt balances. So what does this mean? So red means is that the total debt balances is higher than the baseline. Blue, it means that it's lower than the baseline. So that would be the mean total debt balances in the data. And then what you see here on the horizontal axis, plus or minus. So if you're in the plus, it means that total debt balances for that instance contribute positively to the probability of default. If you're in the negative, they contribute negatively. So if you have a point like this, where you have red, and it's positive, it means that for that particular consumer, in that instance, having more total debt balances relative to the baseline increases the probability of default relative to the baseline. Instead, if you have a blue, say here, hard for me to point out, but say you're here, so blue would mean that for that particular instance, lower debt balances or lower total debt balances relative to the baseline contribute positively to a higher probability of default. So, and this is, the fact that there is a broad distribution of the SHAP values across instances, i.e. consumers, sort of captures the degree of heterogeneity that we have in the data, because the debt portfolio is quite varied across different classes of individual consumers. But basically what we are reporting here are the 12 features that have the highest SHAP values, and it just gives you a sense of, though they have high SHAP values, there's a big distribution across consumers in terms of the SHAP value for each individual consumer. Very quickly, instead, what we're doing here, we are sort of examining the variation of these SHAP values for the most important features over time. And so we just picked 3 quarters, one before the financial crisis, one in the middle, and one after the financial crisis, to see, if in these 3 different periods, different variables came up as being very important in terms of marginally changing the default prediction. And you can see that in all periods, what we find is that total debt balances are the most important feature. And quantitatively, the numbers are in probability units. So 0.07 means that, the SHAP value of total debt balances in 06 Q1, increases relative to the baseline the probability of default by 7 percentage points. So it has a quantitative interpretation. But one thing that there is some time variation in which factors are important other than total debt balances. For example, if we look at number of mortgages, which are the fourth most important features in terms of SHAP value in 06, then they become the second most important feature at the height of the financial crisis, because we saw a lot of mortgage default. And so, and actually what I found in my research is that, people with more than one mortgages are the ones that disproportionately defaulted during the housing crisis. And so this is picked up by the SHAP value here. So in the interest of time, I'm not going to, because I want to talk about the comparison with the credit score, I'm not going to get into the details of this. But essentially what you can see from this exercise is that in practice, we can have a very, very granular view of not only which variables matter most for default in the aggregate, how those can vary over time, but also how they vary across individual consumers. And there is, in fact, quite a bit of heterogeneity across individual consumers in terms of which variable matter most for them in terms of driving their default risk. Now, I'm going to spend most of the rest of the time, and I think I have about 7 minutes, correct, talking about the comparison with credit scores. So credit scores are basically, a device that the industry uses to rank consumers with respect to this predicted probability of default. And they are proprietary models, so we don't know very much about them. So the only thing that the credit scoring companies have to disclose is which are the 4 most important factors that drive the credit score. And so they'll tell you that length of the credit history explains 10 to 15% of the variation. Total amounts owed explain 20 to 25% of the variation. New credit inquiries explain 20 to 25% of the variation, and then delinquencies, mispayments explain the rest. But that's all the disclosure that we have, and there is a cottage industry of fintech companies that can sign up and give you simulation scenarios. If you do this, how does your credit score change, and so on. I'm sure we've all sort of tried those and so on, but there is no public disclosure of what these models, use effectively. What Christina was asking earlier, if you have a delinquency, how long does it affect your credit score? We don't really know. We just know that delinquencies as a whole explain 20 to 25% of the variation in credit scores. We do know that, for example, during the financial crisis, there were a really high fraction of mortgage defaulters who had high credit scores. So there is at least one instance in which credit scores do not do so well. It's hard to compare the credit scores to our model because they're cardinal, our model is more ordinal, but we can always obviously rank consumers as well. But we don't have a lot of information on the performance of the credit score per se because we don't know the model. So, the way we approach in terms of the comparison with credit scores is to look at the implied ranking of consumers, given by the credit score versus the implied ranking given by our model. And so that's the way we compare the two. And so we looked at a bunch of standard performance metrics for the credit score versus our model, and our model does substantially better. This is the area under the curve for the credit score, which is the blue line here. But what really matters for the credit score is not so much whether your credit score is 712 and it should be 715. What really matters is where you fall in terms of 5 industry generated credit categories, which I'm sure you all heard about. So there's deep subprime, near prime, prime, super prime. So how much credit you get, what interest rates you pay depends on where you fall in these 5 risk categories. And so they are determined by credit score thresholds. So what we did is we looked at borrowers in our sample, that are in these different credit score categories. And we asked, where would our model put them? If we used our model to determine or to identify 5 similar categories that have the same size. So for example, the deep subprime is the lowest 5% of all credit scores. So our deep subprime is the 5% of borrowers who have the highest probability of default according to our model. So we define, similar categories based on the ranking, in our model. And we ask, would our model put people in different categories, how many of them, and then we also ask why. So for example, I'm going to show you some results for the largest 2 categories, which are the subprime borrowers. They account for 21% of all borrowers. And basically, for 65% of these, our model would put them also in a subprime category. But our model would put about 15% of them in a lower category and nearly 20% in a higher category. Now, why does this matter? Because if you're in a higher category, you get more credit at lower interest rates. And so in the paper, we have a whole section where we look at the interest rate differential that you would benefit from if you're put in the subprime category, but you're really a prime borrower, according to the model. What's also interesting is that our model, does really well predicting default risk for all types of borrowers. So borrowers with really high risk and really low risk. And the credit score is really better at predicting the very extreme. Are you a really high default risk borrower versus a really low default risk of borrowers, but it makes a lot of mistakes in the middle. So this is a similar exercise for prime borrowers. They account 33% of all borrowers. And again, our model would put 70% or 71% of these borrowers also in the prime category, but then it would put 15% in a higher risk category, and then 13% in a higher risk category. So again, these are pretty big mistakes. So you are classifying, 25% of the population, in the wrong category by using the credit score, which means that these people, get different interest rates and also different credit access. Now, what we also try to do, with our model is to try and understand why, these discrepancies happen. So basically using the SHAP approach that I just showed you earlier, what we can do is basically classify or group features, so variables, in the categories that, the credit scoring companies usually classify variables. I just told you that by law, they have to tell us, which % of the credit score variation is explained by a broad set of factors, say amounts owed or new credit and inquiries. And so, so this is, for the credit score, this is information that we got from Vantage Score in terms of what their model, the variation explained in their model by these different groups of features or variable. And this is, what is predicted by our model. So that what stands out here is that in our model, amounts owed, so total debt balances, total mortgage balances, total credit card balances, have the highest weight, are the most important features in terms of determining, the variation in default risk. And this is much lower for the credit score. On the other hand, the credit score attributes a lot of value to inquiries and new credit lines. So I'm sure you all know that if you apply for a lot of credit, your credit score tanks pretty fast. So this is this effect here. And our model doesn't, give a lot of weight to that. And this is pretty much the biggest the disparities between the two models. Also notable, and I'll get that, and I'll conclude with that in a second, is that, our model doesn't give a lot of weight to credit history. The credit score gives a huge amount of weight to the length of the credit history, so that, borrowers with a short credit history typically have low credit score, pretty much independent of their performance. So this gives us a sense of, why the credit score ranks people differently from our model. But overall, we get a sense that using this methodology, we could be doing quite a bit better. Now, what I'm going to conclude on, and this is actually related to one of Paul's papers, is the impact on vulnerable populations. So essentially what we're arguing is we want to rank consumers based on their probability of default risk. There's better ways to do it. You can get a better performance with some more desirable feature. But one concern is that if you use a better model to rank consumers, you will amplify inequality and access to credit markets, because particularly low-performing consumers might get an even worse ranking with a better model. We do not find that there is strong evidence of that. So what I'm going to show you here, and I'm just going to focus on the age, is the following. So what you see, these bars here are basically the difference in ranking, in risk ranking between our model and the credit score for consumers in different age groups. And that's the blue line. And basically a positive value would mean that, according to our model, these consumers should have a higher score. And you see that the blue is higher for young borrowers. And then the other two bars are depending on realized default history. So the orange is for consumers who don't default. And so you can see that we give them a much higher ranking. And then for consumers who end up defaulting, we give them also slightly higher ranking, but not so high. And so what this graph is telling you is that essentially, our model tends to rank higher, give a higher credit score to young borrowers relative to the actual credit score, which suggests that the credit score penalizes young borrowers too much. And the same picture comes up if you do it by income decile. You can see that for the lowest income borrowers, our model actually gives them a higher credit score, particularly if they end up not defaulting. So this suggests that, the credit score, tends to penalize or misclassify more, more vulnerable borrowers, particularly the young and then low income relative to our model. So it suggests that there isn't a strong trade-off between, having a better statistical model to rank consumers vis-a-vis their default risk and therefore allocate credit versus a model that's, not as precise. So at least we do not find that there would be an adverse impact on these vulnerable borrowers. And I'm going to conclude here. So in the paper, we also do an exercise where we compute the cost savings for lenders of adopting our model versus the credit score, which can be substantive depending on the type of loans. But basically, let me just conclude with saying, we have access to these technologies. We could use them to improve our understanding of consumer default, but also practically on consumer credit markets. And so what we're doing sort of in the rest of our work is dealing more carefully with this issue of fairness and the inequality impact of changing, technology to rank consumers. And we're also working on the strategic versus distressed mortgage default, which I decided not to get into today in the interest of time. Thank you.
Good, thank you. So the floor is open. Again, if you don't talk, I will talk. So,
can I ask one question, Stefania?
Yeah,
I'm glad I got to see you present this. I just had a quick question of how you thought. It seems like very important. What's notable in your context is you have the credit report on the stuff that we worked on. We really only had kind of the mortgage level stuff, which is going to be different than what a lot of originators will see. And I'm curious, but the downside in a lot of the credit report stuff is kind of there's some stuff in credit applications that you don't see. So like your income and kind of like your underwriting path that you've seen there. And I'm curious if a question we've gotten a lot is thinking about, how much of like different data sources and how much they matter and kind of how you think that would interact here. Kind of one of the things you're talking about for like the allocation, this credit score is one input that creditors use in different settings. And so I'm curious if you have thoughts on that.
Yeah, no, actually, we do have thoughts, and that's something that we're addressing more specifically in the paper where we're looking at the fairness issue, but you're absolutely right. So in principle, credit score is going to be just one input, and the lender should have access to more information. And in particular for mortgages, we know that in general, they're quite careful at getting this additional information. And so here, essentially, the kind of assessment that we're doing here is very credit score specific. So if you're concerned that, low-income borrowers, minority borrowers, or young borrowers are being disadvantaged, they may be disadvantaged even conditional on having a higher credit score because there's a bank lending model that is suspicious of, first-time home buyers, say, and those tend to be young. But this says that the credit score itself, which is a crucial input, already has some bias. So even if if you're a regulator and, people who worked on mortgages have found that, using the HMDA data, where, the race of the borrower, that basically African-American borrowers have even conditional on having the same credit score and the same income, have lower or higher denial rates for mortgages and so on. But often when the regulators face an individual lender, with respect to, differential approval rates for mortgages, they'll say, oh, but the population of African-American borrowers or population in this particular neighborhood, which tends to be predominantly African-American, they have a lower credit score, and sometimes that's true, and they justify that. And essentially what we're showing with respect to the characteristics that we observe, which are age and an income estimate, is that the credit score itself, might already be disadvantaging them. And so what we're doing in the paper on fairness, where we're focusing more on race, we use a proxy for race, and then we use, income and age as, categories for which we actually observe the value. But we have this income estimate, which is verified with IRS data, which is very good if you're trying to understand where someone is in the income distribution. Terrible at capturing income shocks, but we think we can, use it effectively for this kind of analysis where, we're saying, let's just look at different points in the income distribution and see if there are differences in performances that are concentrated there, with respect to the credit score versus our model.
Can I ask us maybe a quick follow-up question that's
Yeah.
more related to thinking about the theory of this, which is about, so take this as given, a kind of the way that a lot of these we think about credit score and models is thinking we have some univariate kind of ranking of risk. And we think about an underwriter taking this. And I think one thing that has come up from this is that different lenders have different ways that they want to use that as an input. And I'm curious if you've thought theoretically, like, okay, take this as given, and we've improved this technology. How do we think about that in the context of a kind of a model with lending? They're
Yeah,
different
that's actually a
underwriters.
very
This is
good
a
point. I'm
technology
so glad you
shop.
asked that, because I mean, just thinking about the Chatterjee and Al paper, you know, which is a great paper from a theory perspective. And what they have in the background is that they have agents that have different degrees of patience, and so different tendency to borrow, and that's a highly persistent trait. And so basically, you know, the credit scoring model, you know, which is basically a signal of how patient or impatient they are, you know, is something that keeps track of that, you know, with some degree of error, which gets smaller over time. And you know, and this is also Christina's question earlier, where she asked, so if you have a delinquency, what is the impact on your credit score? So what we have found, not something that we can publish openly, but that even small delinquencies have a very persistent effect on your credit score. And I think that's based on the notion that there is some intrinsic feature that's highly persistent that makes a borrower, you know, very likely or not very likely to default. But in fact, you know, going back to that distribution of shop values for the different features, we see that there's a huge amount of heterogeneity in the population with respect to which variables matter most for a default outcome for a particular consumer at a given point in time, which suggests that, you know, there well may be some traits that make people more or less likely to default and are very persistent. But in practice, there's a lot of very sort of high frequency movements, you know, in variables that change the probability of default, you know, from period to period. And having a model that's flexible enough to capture that is super important. But also from a theoretical level, maybe are thinking that there's this underlying very persistent trait doesn't seem to be squaring very much, you know, with the evidence that we have, you know, both in terms of, you know, descriptive models of who defaults and what they do when they default, but also particularly the findings that we have. Because we do not find that, for example, there is a variable that always has a positive shop value for every person, you know, and as a really high shop value. We do find this huge amount of, you know, heterogeneity in the distribution of shop values for different variables across instances. And so it does suggest that this thinking that there's only one underlying risk factor may be very diminutive for what we see in the data. That's all I have to say on that.